Picture this. It's September 1929. A businessman in Manhattan senses something is wrong. He can't quite name it, but underneath the prosperity, cracks are forming. Acting on pure instinct, he walks into his bank. He presents his passbook. He withdraws every dollar he owns in cash, $12,000 in bills. He tucks them into his briefcase. By Thursday, just 2 days later, the markets collapse. Banks across the country are failing. Panicked depositors line up outside locked doors, but he is safe. He has his money and he can survive the storm. Now, imagine trying that today. It's 2026. You sense the same danger. You try to do what he did. You log into your 401k account. You see $180,000 saved over 20 years. You click withdraw. A penalty calculator appears. Federal tax, state tax, and the 10% early withdrawal penalty for touching your own money before age 59 and a half. Your $180,000 instantly becomes $98,000. And you haven't seen a cent, but here's what makes it worse. The withdrawal doesn't execute immediately. It enters a processing queue. It will take 7 to 10 business days. That's under normal conditions. During a financial panic, when everyone is trying to exit at once, those systems freeze. This is the difference between 1929 and 2026. It's not just that another crash is coming. It's that when it arrives, you won't be able to do what previous generations could. Grab your money and run. Your wealth is trapped inside systems with time locks, penalty gates, and legal restrictions. They are designed to slam shut when everyone tries to leave at once. The 1929 trap was leverage. The 2026 trap is a digital cage. Understanding this is crucial. In 1929, your savings account was simple. You walked in, you presented a passbook. The teller counted cash from the drawer. Same day withdrawals of your entire balance were standard. No processing periods. No approval workflows. No suspicious activity reviews. If you wanted your money, it was yours. Stock ownership was just as direct. You bought shares, you received physical stock certificates, ornate paper documents with your name on them. They weren't digital entries in a database. They were property you held in your hand. This meant investors who sensed trouble had options. They could liquidate, withdraw, and convert to cash or gold. The problem in 1929 wasn't that the system prevented escape. The problem was that most people didn't see it coming until it was too late. They faced a devastating crash. But they weren't facing a system designed to trap them. After 1929, regulators didn't just try to prevent another crash. They built something to prevent people from escaping during a crash. They wanted to eliminate your ability to trigger a bank run. The first cage was the 401. Created in 1978, it was sold as a tax advantage. But it created a $7 trillion pool of American savings. Locked behind those penalty walls, but penalties are just the first lock. The second is time. When you request a 401k withdrawal, it takes 7 to 10 business days. During market stress, timelines extend indefinitely. This isn't a theory. It happened in 2008. Fidelity, one of the largest administrators, suspended certain withdrawal requests for weeks. Participants logged in to find temporarily unavailable messages. Their money was there on the screen. They just couldn't access it. The system includes gates that close during volatility. Then there's banking. Try withdrawing $10,000 or more in cash. Federal law requires the bank to file a currency transaction report on you. Banks also have discretion to delay or deny your request for a suspicious activity review. Your daily ATM limit is $500, even with $50,000. In your checking account, accessing it would require 100 separate transactions over 100 days. The crisis would be over before you could extract your own funds. But the most insidious trap is in your investments. Mutual funds, ETFs, SEC Rule 22E4 allows funds to legally suspend redemptions. That means they can stop you from selling. It's not theoretical. The Woodford Equity Income Fund in the UK suspended redemptions in June 2019. It trapped £3.7 billion for 3 years. When investors finally got their money back, they received 70 cents on the dollar. The 1929 investor could grab cash and run. The 2026 investor will click Withdraw, see a loading screen, and discover the request is pending. The cages are set. But what's the catalyst that slams them shut? It starts in 2022. Inflation hits 9.1%, a 40-year high. But the FDIC will save me. The FDIC's Deposit Insurance Fund has about $128 billion. Total deposits in the U.S. system? Over $17 trillion. The FDIC has enough money to cover 0.7% of all deposits. It was never designed for a systemic failure. This is the trap. The 1929 investor faced insolvency. The 2026 investor faces illiquidity. Your money is trapped. By design, the crash hasn't hit yet. But the early moves are visible. You just have to know where to look. In the fourth quarter of 2024, corporate insiders sold $16.2 billion of their own stock, 4 times the normal rate. These are CEOs and CFOs who see the real numbers. They are getting liquid before something breaks. Sovereign wealth funds are making the same moves. Norway's government pension fund reduced its equity allocation by 18% in 2024. The Abu Dhabi investment, Authority increased its gold holdings to levels not seen since 2008, while they sell. The media tells you to stay the course. The warning signs are flashing. The Shiller-Pay ratio, a measure of market valuation, stands at 39. It was 32 before the 1929 crash. It was 32 before the 2000 dot-com bubble burst. It is 23% higher than both of those peaks. The yield curve has been inverted since July 2022. That's over 39 months. Every single recession in the past 70 years was preceded by this inversion. We are now 39 months in, well past the normal lag time. This is what makes this moment so dangerous. The 1929 investor could act. The 2026 investor is being positioned as exit liquidity. You are the one left holding the bag. The system was designed to prevent your mass exit. Remember that businessman in September 1929. He survived because he had one option you no longer do. He could leave. He didn't need permission. He didn't need to wait 10 business days. He saw the risk, took his money, and got to safety. You don't have that option. The exits have been sealed. So what happens next? There are only two options. Will the government print trillions more to bail out the entire system, sending inflation to 20%? Or will they let the system freeze, triggering a bail-in that seizes your deposits to save the banks? Printing ... or popping? Drop your prediction in the comments below. Then subscribe.